very early on, I think in 2008 in the summer, I spoke a lot with my partner Thorsten Pollard about the crisis. And Thorsten comes from a macro side. He's an Austrian economist, and I didn't have a clue about the macro picture at all. And it was quite interesting to see his views. And I, on the other hand, was looking at balance sheets at that time, especially bank balance sheets. And out of this combination, I learned a lot, and it helped me actually stir my portfolio through the 2008 crisis. And then we kept on discussing this. We kept on thinking about what will this lead to, what's going to happen if all those debts, the whole debt problematic will be transferred from the private side to the public side. And then we came to the conclusion that I think we have something here that others don't really have. And why not think about putting that into a strategy and try to raise money for this and create a new company and an investment management firm that focuses on this. So that's the background. And so we started at looking at first of all the goals. What should it be? And it's, I think, very simple. We would like to beat inflation. So we would like to create real investment returns. And if you look at that, it just means you have to be better than the inflation rate, obviously, but you always have to be even much better because you have to pay capital gains tax on it. So that's the ultimate investment goal, really. And then we started to look at different asset classes. So what are the asset classes that you might be able to achieve this in? And if you think about the categories, I think Warren Buffett used 3 categories, and the first one is everything that you can invest in that has a fixed coupon, so all kinds of money market bills or bonds. They all have the problem that the coupons are fixed, and it's fixed income, and we don't like that because we think that some point down the line the inflation rate will kick in. We don't know exactly when and by how much, but we know it's very likely that it will. And therefore all those instruments in the first category are not really suitable. So the second category that we look at are all assets that you can basically touch and feel, so all real tangible assets. And amongst them, of course, the one that's very popular right now is gold, but everything else would come for it as well. And the problem here is you're basically banking on somebody else paying more for it than you did. So some call it the great fool, but it could work because there might be opportunities in the market where people start to buy more and more of those assets because either they like that asset or they want to get rid of money. And we think that there might be a situation where this will happen, that so that the exchange, the ratio between paper money towards those assets will go up so much that you actually can make more returns than the inflation rate. But it's a high-risk strategy, and we don't really feel comfortable over the long run to do that well. So that leads us to the last asset class, which is anything that produces something, so that produces a return, a yield, like farmland, like real estate, or like productive assets like companies. And a lot of investors also look at the inflation risk, and they look at real estate. So in Germany, for example, I think real estate hasn't done much in the last decades, but since a few years, a lot of investors flock into real estate because they think it's a great investment, inflation hedge. And when you look at it, it could work, but also there's a big risk that that the government does something with your real estate holdings. And if you look at history, in the 1920s, when you had a hyperinflation in Germany and Austria, exactly that happened in Austria. So a lot of people bought real estate as a hedge, and then the Austrian government imposed a cap. And that basically meant that all tenants in Vienna, for example, they could live in their apartments for the cost of one lunch. And therefore the hedge didn't work at all. So in Germany, real estate is called Immobilie, which is immobile, and that's a big risk because the government has a clear record of who owns what, and we see therefore a huge risk as well if you deal with real estate. It might work, but there is risk involved. So that leads us to the last one, which is companies. And with companies, the interesting bit is that they also have problems, or most of them have problems during inflation. And if we look at the history, if you look at, for example, the return on equity of companies over the long run, they didn't react really to inflation in the 70s. And Warren Buffett wrote a paper in 1977 about this, and he showed that return on equity is quite sticky. So if return on equity is around, over the long run, around 12.5%, and inflation is at the same rate, then obviously over the long run you won't make any money with equities. So equities on aggregate are not an inflation hedge.